Ladies and gentlemen, let me be clear right from the outset. We are living in a time of profound economic significance, a time when the decisions we make today will echo through the lives of future generations. We are at a critical decision point in the global economic system, a moment that history shows us rarely comes without consequence. We are at a critical decision point in the global economy, and that phrase isn't mere hyperbole or financial media sensationalism. It's a reflection of the convergence of forces that, when examined historically, signal that the world economy is approaching a pivot that could determine whether the next decade is remembered for stability and renewal or for turmoil and retrenchment. At its core, this moment is defined by three defining dynamics: unsustainable debt levels, shifting world order, and internal fractures in societies around the globe, all happening at the same time in a way that history shows is rare and consequential. The first piece of this picture is debt, not just high, but structurally embedded at levels that strain the financial system. When you think of debt, don't think of it as a simple ledger entry. Think of it like the arteries in a living organism. When they begin to clog under excess plaque, the system still functions until suddenly it doesn't. Government debt in major economies has ballooned. In the United States, for example, debt to GDP has surpassed levels not seen since World War II, and service costs are crowding out other priorities at an accelerating pace. If the supply of new debt continues to outstrip the world's willingness or ability to absorb it, we could see a loss of confidence that reverberates across markets. The second force shaping this critical moment is the transformation of the global order itself. For 70 years after World War II, a U.S.-led multilateral framework shaped trade, capital flows, and geopolitical relationships. That framework is now under strain. Protectionist policies, tariff battles, and escalating competition between major powers are undermining the stability that decades of cooperation built. What were once exceptions, trade disputes or currency tensions, are now becoming norms, and as these geopolitical stresses rise, they compound economic risk rather than mitigate it. Third, internal conflicts within nations, social, political, and economic, are breaking down the cohesion that underpins market confidence and effective governance. Wealth inequality has widened in many major economies, eroding trust and amplifying polarization. As people lose faith in institutions, the political will to enact difficult but necessary fiscal and structural reforms weakens. Democracies struggle to build consensus on long-term strategies, leaving them vulnerable to short-term pressures that exacerbate economic imbalances instead of correcting them. This erosion of internal order feeds back into economic fragility, making it harder for countries to navigate external shocks viewed through the lens of historical cycles. These conditions echo the phases preceding some of the most tumultuous economic and political transitions in modern history. In the past, when debt soared, when external pressures mounted, and when internal cohesion frayed simultaneously, the results were transformative and often disruptive. The crisis of the 1930s, major mid-century geopolitical shifts, and the financial upheaval of 2008 were all born of overlapping systemic stresses, and they reshaped societies and economies in profound ways. Understanding these patterns isn't pessimism, it's preparation, but where there is challenge, there is also choice. The very fact that we are at a decision point means that policy responses, particularly those rooted in fiscal responsibility, cooperation across borders, and strengthening social fabrics, can tilt outcomes toward resilience rather than breakdown. This isn't about predicting doom. It's about recognizing risk vectors that are real, interrelated, and historically significant. For citizens, investors, and leaders alike, the way forward demands clarity, courage, and an eye on long-term stability over short-term Term gains. What makes this moment critical and what makes understanding it essential is that the consequences are not abstract. They affect employment, inflation, access to capital, international relations, and the overall economic security of people around the world. We have the analytical tools and historical insights to grasp what's happening. The real question now is whether we will act on that understanding with the urgency that the situation warrants. We need to understand what it really means when a country's debt and fiscal imbalance become systemic risks, because that is the context in which some of the most consequential economic forces play out. It's not an abstract concept. It is a structural condition, like the foundation of a house weakening, that quietly erodes resilience until, if it's ignored long enough, serious damage occurs. What makes the current situation so distinct is not just that the numbers are large, it's that the rate of growth of the debt, the political unwillingness to restrain it, and the responses from global investors have all combined in a way that historically marks the final phase of a debt cycle. At its simplest level, fiscal imbalance means a government is spending more than it earns year after year, with no credible plan to reverse course. When this persists, the total debt keeps growing at the same time that the cost to service that debt rises, because interest rates move higher as investors demand more return for taking on risk. As interest costs climb, they crowd out other necessary spending: education, infrastructure, health care, and a larger share of tax revenues goes simply to pay interest to bondholders rather than to productive investments. This is neither theoretical nor distant. In the U.S., interest costs on the federal debt have reached levels that make the debt service one of the largest outlays, only behind Social Security, defense, and health care, a clear sign that the structure is strained. There is also the supply and demand dynamic that comes into play. When government deficits widen and debt issuance expands rapidly, the Treasury must sell more bonds to finance that gap. Normally, there is plenty of demand for government debt because investors see it as a safe asset. But when debt grows faster than the economy and the supply outpaces demand, investors start requiring higher yields to hold that debt, which pushes borrowing costs up further. In 2025, for example, heavy deficits coincided with rising yields in the Treasury market, at times reaching levels not seen in years, and even triggered a ratings downgrade by Moody's, a rare event that signaled rising skepticism about the credit quality of U.S. debt. The danger of such a dynamic is not simply that the government owes a lot of money, it is that when debt issuance outstrips demand, you can reach a point where the market begins to doubt the long-term viability of the full faith and credit backing that debt. That doubt can feed a vicious feedback loop. Higher yields, higher interest costs, poorer fiscal balances, even less confidence, and then even higher yields again. A cycle that is extremely hard to break. Economists sometimes call this a debt spiral, and once underway, it is very costly to arrest without significant policy intervention. Historical experience also teaches that sustained fiscal imbalance corrodes economic flexibility. Governments have fewer tools to respond to downturns if much of their budget is devoted to past commitments. And as deficits and debt mount, the room for maneuver shrinks. Politically, this can create pressure to inflate away debt, raise taxes, or cut critical services, all of which are socially and politically contentious choices. In the absence of bipartisan consensus and prudent budgeting, the risk is that you end up with policy oscillation and uncertainty, which in itself can harm growth and investment. Another structural risk emerges when foreign holders of that debt begin to reassess its attractiveness. Historically, governments with reserve currencies like the U.S. dollar benefit from strong global demand for their bonds, but persistent deficits can shift that calculus. If other countries reduce their holdings or diversify away from that debt as a store of value, the U.S. could face even more upward pressure on yields or a weakening currency. That doesn't happen overnight, but over time it erodes the implicit advantages of having a dominant reserve currency and increases systemic risk in financial markets. So what does all this mean for the broader economy? It means that fiscal imbalance is not merely about having large numbers on a spread sheet. It affects confidence, investment flows, interest rates, and ultimately the real economy, jobs, consumption, and growth. When governments struggle to finance their obligations sustainably, policymakers are forced into difficult trade-offs that can constrain growth or precipitate sharp corrections. The choice, from a policy perspective, is between acting early, reducing deficits, rebalancing spending and revenues, and restoring investor confidence, or allowing the imbalance to worsen until a crisis forces adjustments that are much more painful and disruptive. Understanding this is critical because debt and fiscal imbalance are the bedrock structural factors that influence nearly every other macroeconomic outcome. They aren't symptoms, they are root causes. And addressing them requires not just awareness, but disciplined, sustained fiscal policy, and crucially a political willingness to tackle hard choices before they become unavoidable. We need to think of a recession for what it is. 2 negative quarters of economic output, a contraction in GDP, often accompanied by job losses and softer demand. That's the textbook definition, and most economists are comfortable describing downturns in those terms. But what some observers are warning about now is not just a recession, and not just a slowing economy. It's a deeper and broader breakdown of key economic, monetary, and systemic orders that historically has signaled far more profound disruption than what we typically call a recession. A recession is something that economies go through repeatedly. They come and go. But when you see multiple critical systems, monetary, fiscal, geopolitical, all being strained and potentially breaking down simultaneously, you're no longer talking about a normal business cycle downturn. You're potentially talking about a breakdown that reshapes the rules of the economic game, not just a temporary contraction in economic activity. For example, in recent commentary on the U.S. and global economy, the concern has been raised that the monetary order itself is under stress. The monetary system, the role of the U.S. dollar as the backbone of international finance, the functioning of credit markets, and the confidence that people have in money as a reliable store of value is not immune to structural pressures. When large deficits, high debt, and shifting confidence in the value of financial assets are combined with geopolitical uncertainty, the stability of that system comes into question. That's not a minor technicality. It goes to the heart of what makes markets function. A recession can be painful. Companies lay off workers, investments shrink, consumers tighten their belts, but the economy still operates within a known framework. Credit still flows, currencies still serve as reliable mediums of exchange, and international trade continues with predictable rules. In contrast, a systemic breakdown would mean that some of those very foundations become unreliable or even fractured. Imagine a scenario in which confidence in government bonds, traditionally seen as risk-free, is no longer assured because deficits and debts have grown too large relative to economic output, or where trade and investment flows are disrupted due to escalating geopolitical tensions. In such a world, the normal engines of growth and stability become impaired. What makes the difference between a regular recession and this more profound kind of breakdown is not just severity but scope and persistence. A recession, by definition, is often temporary. Eventually growth resumes. But when fundamental structures like the monetary system or the trust in institutions that manage it are under strain, the consequences can be longer and reach deeper into how economies and societies function. It's not merely less output, it's less predictability and less structural integrity. History offers some lessons. In the 1930s, the world experienced not just a recession but a Great Depression, where policy missteps, monetary contractions, and breakdowns in international cooperation exacerbated the downturn, leading to prolonged pain, social unrest, and geopolitical turmoil. Similarly, when the monetary order faced disruption in 1971, with the breakdown of fixed exchange rates and the end of the Bretton Woods system, the global economy underwent a significant adjustment period, testing confidence and redistributing economic power. These are not your garden variety recessions. They're structural transformations in today's environment. Several factors raise this risk beyond normal recessionary fears. Large and growing government deficits and debts have the potential to erode confidence in fiscal sustainability. If investors begin to demand significantly higher yields for holding government debt, effectively charging more to bear risk, this can strain public finances and ripple through financial markets. Add to that trade conflicts, rising geopolitical tensions, and a shifting global balance of economic power, and you have multiple stressors hitting the system concurrently. Another layer of concern is the potential breakdown in the domestic order. When political polarization makes it difficult to enact coordinated fiscal and economic policy, governments might be unable to respond effectively to shocks. That inability to act, or worse, conflicting signals from policymakers, can exacerbate downturns and prolong recovery. In some historical episodes, political fractures have deepened economic distress, not mitigated it. So when we talk about the risk of a breakdown beyond a simple recession, we're recognizing that today's economic vulnerabilities aren't isolated to slowing growth figures. They touch on the integrity of the systems that underpin economic activity: monetary stability, fiscal balance, international cooperation, and institutional trust. A breakdown in those systems doesn't just mean shrinking GDP, it means rethinking how the economy functions, which could be far more disruptive and long-lasting than a typical downturn in that sense. The real risk isn't just recession, it's the erosion of the frameworks that make sustained, predictable economic growth possible. Recognizing that possibility doesn't mean expecting catastrophe, but it does mean preparing for scenarios where conventional policy tools and assumptions may not suffice. The sooner that policymakers, investors, and citizens understand the full spectrum of risks beyond a simple recession, the better positioned they will be to respond thoughtfully and proactively. When we talk about debt cycles repeating throughout history, we're talking about a pattern, not random sequence of events, but a recurring force that shapes economies over decades and even centuries. This isn't just about the occasional downturn or financial crisis. It's about how debt, credit, confidence, and human behavior interact over long periods to create predictable phases: expansion, excess, breakdown, and restructuring. What we're seeing now fits squarely within that long-term historical pattern throughout history. Economies expand as credit becomes widely available, boosting spending, investment, production, and asset prices. In the early stages of any debt cycle, borrowing fuels growth. Individuals take on more debt to buy homes, businesses borrow to expand, governments borrow to stimulate, and banks create credit that lubricates the wheels of the economy. This early expansion feels good. Incomes rise, asset prices climb, and confidence builds. That's when people forget that all the expansion was powered by borrowing against the future. This pattern has played out many times before. For example, after World War II, the global economy entered a long debt cycle built on rebuilding and expansion under the Bretton Woods system. Debt grew relative to incomes as central banks kept interest rates low and governments expanded spending to fuel growth. Over decades, short-term debt cycles, each with its ups and downs, built upon each other, increasing the overall level of debt in the system. The economy grew, but so did obligations that needed to be serviced in the future eventually. As any historical case demonstrates, debt levels become so large relative to incomes and resources that the costs of servicing that debt begin to choke off productive investment. Servicing debt increasingly takes priority over new investment, crowding out spending on infrastructure, education, and innovation. We saw similar dynamics in previous centuries as well, such as financial crises in the 19th century, when banking collapses and sovereign defaults followed speculative expansions fueled by credit. The British credit crisis of 1772-73, sparked by excessive speculation and expanded credit, quickly led to widespread bank failures across London and beyond. The panic of 1819 in the United States illustrates another phase in this repeating pattern. Excessive speculation and rapidly expanding credit following the Napoleonic Wars produced a sharp contraction that had lasting effects on economic output and confidence. These earlier cycles, though in very different economic contexts, had the same fundamental structure. Credit expands, debt accumulates, a contraction follows, and the cycle resets for the next long period. Then there is the pattern of global waves of debt, identified by broader economic research. These waves show periods where debt accumulation became widespread across both developed and developing economies, followed by financial crises and adjustments. According to analysis of global debt history, there have already been several major waves of debt accumulation over recent decades, and each of these has ended with stress on household finances and public sector balances that reverberates through the whole economy. What this historical record tells us is not that every cycle looks exactly the same, they don't, but that the mechanism driving them is remarkably consistent. Debt grows faster than incomes during expansions, confidence rises to unsustainable levels, and eventually the capacity to service that debt without restructuring or deleveraging becomes strained. When that strain becomes acute, policy responses, whether monetary easing, debt restructuring, or fiscal austerity, are necessary to reset the cycle. One key feature seen over and over again is the shortage of policy room after decades of debt accumulation. In the early stages, central banks can lower interest rates and stimulate the economy when things slow. But as debt grows larger and interest rates hit zero or near zero, the ability to stimulate fades. At that point, governments resort to other measures, printing money to buy debt or fiscal spending to support demand, which in turn increases liabilities even further. That sets the conditions for the final stage of a cycle: restructuring, inflation, or forced deleveraging. History shows that happens because the tools that worked in the early expansions aren't as effective later in the cycle, and it isn't just economic variables that repeat. Human behavior and policy responses repeat too. When times are good, policymakers and citizens alike want to spend more rather than tighten belts. The confidence of the middle of the expansion blinds participants to risks building underneath. When downturns come, as they inevitably do, the initial response is often denial or delay, compounding the problem. Eventually, all parties are forced to confront the imbalance, and that confrontation is often uncomfortable and disruptive even at the global level. Nations have historically had to negotiate and restructure debt after periods of excess. The London Debt Agreement of 1953, where German external debts were restructured after World War II, is an example of how countries in the past dealt with unsustainable debt burdens and reset expectations. The repetition of these cycles is not destiny written in stone, but it is a structural pattern driven by incentives, psychology, and the mechanics of credit and debt. Understanding this pattern helps investors, policymakers, and citizens anticipate where we are in the cycle and respond proactively rather than reactively. Rather than being caught by surprise, studying the repeating debt cycle can guide better decisions, whether tightening fiscal policy early, building buffers in good times, or preparing for the inevitable adjustments that come at the end of these long arcs. In the end, what history teaches is that debt cycles are neither anomalies nor one-off events. They are fundamental to how credit-driven economies evolve, strain, and reset themselves, and they repeat because the underlying mechanics of debt and human nature remain constant over time. So let me end with this. The truth about the economy is not that disaster is inevitable. It is that preparedness and wise action determine outcomes. The economic forces at play are powerful, but they are not beyond human agency. What matters most is understanding the cycle, recognizing the risks, and acting with intelligence, discipline, and patience. Your financial security, your future prosperity, and the well-being of this generation depend on knowing these truths and responding wisely. Thank you.